Hello, my name is Surga. I am going to explain High Aspiration Private Limited Company taxation return. High Aspiration Private Limited Company is an Australian company that sells coffee to other businesses. The company uses accrual accounting and pays tax at 30%. The owners Sally and Rob want advice on how to reduce their tax for the year 2024 to 25. We need to look at what income must be taxed like sale and dividends, what expenses can be claimed like wages, super fringe benefit tax and depreciation, how to treat trading stock inventory. The company also paid dividends and PYG installments during the year. Our job is to work out the company's taxable income, calculate how much tax it has to pay, and suggest legal ways to reduce the tax. Now, the next slide is on this slide we can see how the company's taxable income is calculated. First, the company earned 325,000 in sales after adjusting for receivables. It also received 14,769 in dividends plus a franking credit of 3,769. This gave a total income of 343,538. Next, we subtract expenses. These include trading stocks, wages, superannuation, fringe benefit tax, other costs, and depreciation on motor vehicles. Total expenses come to 209,687. After deducted expenses, the taxable income is $133,851. The company then pays a tax at 30%, which is equals to 40,155. After applying the franking credit, the tax reduces to 36,386. The company already paid 5,210 in PYG installments, so the final amount is payable 31,176. This calculation follows tax rules and show how deduction help reduce the company's tax. Now the next slides show each item in the company's account is treated differently for tax. Sales are counted as normal income. Dividends include extra credits like franking credits which affect tax. Trading stocks is usually valued at the lowest value to reduce tax. Superannuation contribution can be claimed as a deduction when paid. Fringe benefit tax can also be claimed as a deduction. Motor vehicle lose value over time, so depreciation is claimed, often higher in early years. PYG tax payments are not deduction because they are just advance payments. These rules help calculate the correct taxable income. Now, Mandeep is going to explain the next slide.
My name is Mandeep. My student ID 1618503. Today I explain next slide facts and issues. This slide explain capital gain tax CGT. Sally owns share in her own name and Rhodes share are owned by his company High Aspiration Private Limited. Both of them sold their shares on 20 August 2024. Sally also has a capital loss of $600 from last year, which can reduce her tax tax. The main tasks are calculate profit or loss on each share, apply the correct CGT method, find the final net capital gain. Individuals like Sally can get a 50% discount if they held the share for more than 12 months. But companies do not get this discount, so our goal is to find Sally's net capital gain in the best way and also calculate the company's net capital gain. Move to the next slide, please. The next slide is Sally's CGT outcomes. Sally's shares gave different results. Some made profit and some made loss. RI shares gave a profit of $4,000 and qualify for 50% discount. BBC share made a big profit of $75,000, also eligible for this discount. QN shares had a loss of $500 and the TLC shares made a profit of $3,100 but no discount because they were held for less than 12 months. So total profit before losses is equal to $82,500 after subtracting losses of $1,100. The net gain becomes $81,400. Then we apply the discount method to ROE and BBC shares, which cuts their gains in half, that reduce the total taxable gain to $40,800. Finally, after adjusting losses, Sally's final net capital gain in $41,700.
Hello, my name is Rupinder Kaur. I'm going to explain the next slide, high aspiration CGT outcomes. In this slide shows Rhodes portfolio, which is held by his company High Aspiration Private Limited. It is includes BHP shares bought in March 2024 and ANZ shares bought in June 2021. The gains from these shares are $17,000 for BHP and 7,200 for ANZ, making a total of 24,200. Since the shares are owned by a company, the tax treatment is different from individuals. Unlike individuals, companies cannot use the 50% CGT discount, so the full 24,200 gain is included in taxable income with the corporate tax rate 30%. 30%, this result in $7,260 tax payable even if shares are held for a long time. The company does not get any discount. This highlights the difference between corporate and individual taxation. Next slide, comparative outcomes. Unlike individuals, companies cannot use the 50% CGT discount, so the full 24,200 gain is included in taxable income with the corporate tax rate 30%. This results in 7,260 tax payable. Even if shares are held for a long time, the company uh, does not get any discount. This highlights the difference between corporate and individual taxation. So, to conclude, this comparison shows that individuals like Shelley benefits from CGT discounts, lowering their taxable gains, while companies must pay full tax. Effective tax planning, including depreciation method, timely super contributions, applying CGT discounts for long-term holdings, and planning dividends helps both companies and individuals minimize tax, minimize wealth, and stay compliant with ITAA 97. The main takeaway is structuring investments wisely makes a big difference in tax efficiency and long term financial outcomes. Thank you very much.